Let's jump right in. Welcome to this explainer. Today, we're diving into a complete blueprint for turning your savings into a finely tuned financial engine. Think about it. Your money shouldn't just be a static pile of cash sitting around doing nothing, right? It's a dynamic machine. And if you want it to actually run smoothly and get you to your financial destination, you absolutely need the right parts working together. So let's look at exactly how to build that machine.
Here's our roadmap for today. We're going to cover 5 quick steps: why diversify, the 3 portfolio pillars, comparing asset classes, recommended allocation frameworks, and finally, the key rules for implementation.
All right, take a look at this complete blueprint. This right here gives you that bird's eye view of your entire portfolio strategy. We're going to zoom in and decode every single piece of this setup, so you know exactly how these components interact to actually build your wealth.
Moving on to step 1. Why diversify your savings? The ultimate balancing act.
So, the eternal investing trilemma comes down to this. We constantly have to balance our tolerance for risk, our need for growth, and our absolute necessity for inflation protection. It's tough, right? I mean, if you go all in on safety, inflation acts like a slow leak in your tire, just quietly eating away your purchasing power over time. But if you swing the other way and go all in on growth, well, a market crash could literally total the car. Diversification isn't just some corporate finance buzzword. It's the ultimate balancing act you need to protect your hard-earned money from these competing forces.
Which brings us to part 2, the 3 portfolio pillars, or the parts of your machine.
First up is your core engine, mutual funds. These guys do the heavy lifting of broad, low-effort diversification. Since they're managed by professionals, they spread your risk out across a ton of different assets. You don't have to stress about picking the winning horse. You just own the whole track. This pillar is absolutely perfect for steady compounding over time, and the best part? You don't have to sit there watching the markets every single day.
Next, we bolt on the growth boost using direct stocks. This is where you get to make targeted bets based on your own research and conviction. Direct stocks give you voting rights and essentially unlimited upside potential. And it's a big but, just like any high-performance mod on a car, it brings high volatility and serious risk. It's thrilling, and for sure it can supercharge your returns, but you definitely have to be prepared for a bumpy ride.
Finally, we have the inflation cushion, which uses commodities. Think gold, silver, and industrial metals. This acts as a safe haven for your capital. The real beauty of commodities is that they often move inversely to the broader markets. So when stocks are tanking because of geopolitical stress or some economic panic, your commodities are there providing stability. When the rest of your engine overheats, this right here is your coolant. It's a highly reliable hedge against inflation.
Okay, let's hit step 3, comparing asset classes. Basically, the spec sheet.
When we lay these out side by side, the operational differences become super clear. Just look at the time commitment required here. Mutual funds? Very low time commitment. You're basically just setting up an SIP, a systematic investment plan for that steady compounding. But direct stocks, they demand a ton of time and high risk to chase that high growth, all managed through your Demat account. Then you've got commodities sitting somewhere in the middle, giving you an inflation hedge with moderate to high risk, usually accessed via ETFs or bonds. You can clearly see how every single asset plays a highly specialized role.
Moving right along to step 4, recommended allocation frameworks. Let's assemble this engine. So if you're a moderate or balanced investor, your framework anchors heavily on that core engine. You're going to put 50% in mutual funds to build a massive, stable base of steady compounding. Then you allocate 30% to direct stocks for a nice, reasonable growth boost and reserve a solid 20% cushion in commodities to protect yourself against market shocks and inflation. It's a highly resilient, well-rounded setup. But if you consider yourself an aggressive, growth-focused investor, check out this dramatic shift. Direct stocks take the lead at a massive 50%. But pay close attention to why this process changes exactly 10% across the board. To fuel that high-octane growth, you literally have to siphon fuel from somewhere else, right? You are actively choosing to reduce your steady core of mutual funds by 10%, dropping them to 40%, and you're shrinking your safety cushion of commodities by another 10%, leaving just 10%. That 10% shift is the literal price. It's the true opportunity cost you pay for aiming at higher potential returns.
The really crucial takeaway when comparing these directly is this: the aggressive strategy fundamentally trades a significant chunk of its inflation protection and core stability for maximum exposure to those high-growth, high-risk assets. You're literally swapping out that 10% of safety padding for a bigger engine. And hey, there's no right or wrong answer here. It entirely depends on what aligns with your personal risk tolerance and your specific financial goals. Now for our final step, Section 5, Key Implementation Rules for Maintenance and Operations.
To keep your engine from breaking down the road, you've got 3 non-negotiable maintenance rules. Step 1, avoid overlap. Make sure your mutual funds aren't just buying the exact same direct stocks you already hold on the side, otherwise you're not actually diversifying at all. Step 2, use digital commodities. Please, don't hoard physical gold bars under your mattress. Use modern tools like ETFs or bonds for way better security and liquidity. And step 3, rebalance annually. As markets naturally move, that perfect 50-30-20 split is going to drift. You absolutely have to step in and reset your portfolio once a year to maintain your target percentages and keep your risk exactly where you want it.
As we wrap up this explainer, I want to leave you with one vital question to think about for your own wealth-building journey. Based on everything we just broke down, are you naturally a moderate investor looking for that steady 20% cushioned ride? Or are you ready to sacrifice that 10% of padding to build a highly aggressive, high-growth machine? The choice is entirely yours. Keep learning, keep adjusting, and I'll see you in the next explainer.